Today we are entering the world of options trading. Have you ever wondered how you can make money on the financial markets not only with shares but also with options? If so, you've come to the right place. This video gives you a quick, compact, and exciting introduction to options trading, just what you need to understand the basics and get started right away. And don't worry if you think you'll have to watch hundreds of hours of videos first. We'll keep this short and sweet, but don't worry. You'll still get everything you need to know. And if you want to dive deeper, there are of course a whole series of more in-depth videos that will show you even more. I promise that after watching this video, you'll have a solid understanding of what options are, how they work, and why they should be an integral part of your investment portfolio. Because the world of options trading is so much more than just numbers and graphs. It's an exciting game of strategies, opportunities, and the art of recognizing the right moment. So sit back and immerse yourself in a world that will help you see the market from a whole new perspective. But before we start, imagine you're at a flea market. You pass a stall with an antique clock, one you've always wanted. It costs $100, but you don't have enough cash on you at the moment to buy it. The dealer says to you, "You know what? You can reserve this watch for today. Just leave me $10 and you can buy it later for $100 if you want." That's exactly what options do. They give you the right, but not the obligation, to buy or sell something at a certain price. In the case of the watch, you bought the right to buy it for $100 for $10. The option to buy it is up to you, but you can just leave it if you don't want to. So let's get started with the question that probably all of you have, and which the example just mentioned illustrated quite impressively. What actually is an option? You pay a small amount, the so-called premium, and get the right to buy or sell a share at a certain price, the so-called strike price, but you don't have to do it. If you don't, you simply lose the premium you paid. The big question, so why would you trade options and not just buy the shares yourself? Imagine you have the opportunity to enter into a contract that gives you the right to buy or sell a stock at a later date and at a certain price. It's like a kind of insurance, but you decide for yourself whether you want to take advantage of it. Sounds exciting, doesn't it? But wait, that's not all. Here you can see a chart with various options for the Amazon share. There are call options, put options, and lots of different strikes and maturities. Don't panic, it will all become much clearer in a moment. So let's dive deeper into the basics. An option is a contract between two parties. One party buys the right to buy or sell a share at a certain price, the strike price. The other party sells this right, and the buyer pays a so-called premium for this right. And now it gets really exciting. You can not only exercise these options yourself, but also sell them on. In other words, you can trade with a contract without ever having to own the shares yourself. The difference between call and put options. There are two types of options you can work with: call options and put options. Each of these options has its own strategy and purpose. Let's go through both and explain with practical examples when you should use which one. Call options. Call options. A call option gives you the right to buy a stock at a predetermined price, but you're under no obligation to do so. You buy this option because you assume that the price of the share will rise. Example, imagine you buy a call option on Apple with a strike price of $200 and pay a premium of $10. You now have the right to buy Apple shares for $200, no matter how high the price actually rises. If the price rises to $240, you can buy the stock at $200 and immediately sell it for $240. Your profit? $40 per share, minus the $10 premium you paid. That means you've earned $30 per share without having to buy the full stock. Why does that make sense? Because you only invested $10 to realize the potential profit of $40. The advantage, you can bet on large price movements with a small investment. And if the price doesn't rise or even falls, then you only lose the $10 premium. Put options. Put options. A put option gives you the right to sell a share at a predetermined price. You buy a put option if you assume that the price of a share will fall. If the price falls, you can sell it at a higher price than the market price would allow you to. Example, let's say you think Tesla's shares will fall, which are currently at $430. You buy a put option on Tesla with a strike price of $380 and pay a premium of $15. If Tesla's price actually falls to $380, you can still sell the stock for $430, giving you a profit of $50 per share. Your net profit? $50 minus the $15 premium. So $35 per share. Why does this make sense now? Here you profit from falling prices. You are betting on the downward trend of the share without actually owning the share. However, if the price does not fall, you only lose the premium you paid. Why should the whole game be interesting for you now? Quite simply, options can allow you to profit from price movements without having to buy or sell the stock itself. It's like betting on the direction in which the market will move. And the best thing about it, you don't have to pay the full amount for the share, just a small premium. The premium. How much does an option cost? The most important component in options trading is therefore the premium. The premium is the price you pay to buy the option. It works like an insurance policy. You pay a small amount to acquire the right to buy or sell a share at a certain price. This premium depends on various factors. The price of the share. The more expensive the share, the more expensive the option usually is. The strike price. The closer the strike price is to the current market price, the higher the premium. The remaining term of the option. Options with longer terms tend to be more expensive as they have more potential to go into the money. Volatility. If the market is particularly volatile, premiums rise because the probability increases that the price of the share will move in a direction that is advantageous to the option holder. What happens when the option is in the money or out of the money? In options trading, we often talk about the terms in the money and out of the money. Let's explain this briefly so that you don't stumble when you hear these terms later. In the money, ITM. 1. Call. Option. A call option is in the money when the price of the stock is higher than the strike price of the option. For example, if you bought a call option on a stock with a strike price of $400 and the price of the stock is $440, your option is in the money because you can buy the stock at a lower price. Put option. A put option is in the money if the share price is below the strike price. Suppose you have a put option on a stock with a strike price of $150 and the stock is at $120, then you have the right to sell it at $150, which would give you a profit. 2. Out of the money, OTM. Call option. A call option is out of the money when the market price of the stock is below the strike price. So if the price of the stock is $200 and your call option has a strike price of $250, it is out of the money because you would buy the stock at a higher price than it is currently worth on the market. Put option. A put option is out of the money if the price of the stock is higher than the strike price of the option. Let's say your put option has a strike price of $150, but the price is $170, then your option would be out of the money. Let's go through the whole thing again using a concrete example so that you can internalize the differences in detail. Imagine the Microsoft share is at $400. You see a call option on Microsoft with a strike price of $450. What does that mean? Quite simply, you can buy this option and have the right to buy Microsoft shares at $400, even if the market price is much higher, let's say $500. You pay a premium of, for example, $6.30 per share, i.e., a total of $630 for 100 shares. And here's the best part. If the share price actually rises and climbs to $500, you can still buy the shares for $400 and sell them immediately for the market price of $500. That means a profit of $50 per share. So, with a small premium, you can make a big profit. Of course, there's also a risk. If the price doesn't rise and the stock doesn't end up going above $450, the option becomes worthless and you lose all the premium you paid. But hey, that's the price of the right. Now you might be thinking, okay, that's cool, but what happens if the share price falls? The risk of options trading. Of course, options trading is not without risk. As the buyer of the option, you lose the premium you paid if the market does not move in the direction you want. As the seller of the option, you can theoretically suffer unlimited losses as you are obliged to fulfill the option if the buyer exercises it. But don't worry. With a well-thought-out strategy and risk management, you can control and minimize the risk. Why should you trade options? Now, you may be asking yourself, why should I even bother with options when the stock market is already so lucrative? The answer is quite simple. Options offer you flexibility and many opportunities to maximize your profits for a fraction of the investment. Leverage. Options allow you to profit from price movements without paying the full amount for the share. You can therefore make larger profits with a smaller investment, but also higher losses if the market moves against you. Hedging. Options can also serve as a portfolio hedge against losses. If you already own shares and are worried that the market could fall, you can buy put options to help limit your losses. Speculation. You can also use options simply as a means of speculation to profit from the movement of a market without buying the underlying stock. The big question you should ask yourself now is, can you, as a buyer or seller, really predict the movements of the market? Not always, of course, but with the right strategy, good market observation, and the necessary knowledge, you can learn how to use this game to your advantage. Strategies in options trading. If you really want to delve deeper into options trading, there are numerous strategies you can use. In order not to go beyond the content of the video, I will briefly introduce you to the following 3. Covered calls. One of the most popular strategies where you sell a call option on a stock you already own. This generates additional income from the premiums while you continue to hold your shares. Protective puts. A type of insurance for your stock portfolio, where you buy put options to hedge against large price losses. Straddle and strangle. Strategies where you buy both call and put options on a share to profit from large price movements in either direction. These strategies can be very lucrative but require good timing. Of course, there is much more. In the next videos, we will take a closer look at how the price of an option is made up, how you can manage the risk and which exciting strategies you should use and when. The world of options. Once you have mastered options trading, new lucrative opportunities will open up for you to profit from the constant ups and downs of the market. But remember, as with everything in life, it takes practice, patience, and a clear strategy. It may seem complex at first, but with the right approach and a gradual learning curve, you can become a true options pro. Try it out, and watch your portfolio reach new heights through options trading. The financial markets are exciting and always on the move, and options are another tool for successfully getting involved. Are you ready to dive deeper and master the game? Then stay tuned. See you in the next video.